A billionaire and a school teacher can earn the same dollar and still pay completely different taxes. That sounds impossible until you understand a basic fact of modern finance. Wealthy people are usually not taxed on what they own, but on what they sell. And that single distinction changes everything. If your income comes from a salary, taxes are almost unavoidable. Every paycheck is visible, reported, and taxed before the money even hits your bank account. But if your wealth sits inside a company, a portfolio, or a piece of real estate that keeps rising in value, you can become extraordinarily rich without ever triggering the same tax bill. In other words, the tax system often rewards the ability to live off assets rather than wages. That is why the phrase "billionaires don't pay taxes" is both true and misleading. They do pay taxes, sometimes a lot of them. But compared with their economic power, their effective tax rate can be surprisingly low, and the reason is not hidden fraud. It is legal structure, timing, and the way the tax code defines income in the first place. The first thing to understand is that in many countries, especially the United States, the core tax base is realized income. Wages are realized immediately. Capital gains are not. If a billionaire owns stock that rises from $100 million to $500 million, that $400 million gain is real in an economic sense, but not taxable yet if the stock is not sold. The government is waiting for a realization event. That delay is the first major loophole. Except it is not really a loophole. It is the architecture of the system. And this is where the public often misunderstands the issue. People imagine rich individuals living on giant salaries. In reality, the ultra-wealthy often design their finances so that income appears only when necessary. A founder may draw a modest salary from their own company. A real estate investor may receive tax-advantaged depreciation losses. A tech billionaire may borrow against stock instead of selling it. To the tax code, those are very different things. Borrowing against assets is one of the most important mechanisms in the billionaire playbook. If you own a large block of appreciated stock, you can use it as collateral for low-interest loans. That borrowed money can fund a lifestyle, new investments, or even tax payments without creating taxable income. The loan proceeds are not income, they are debt. As long as the borrower does not sell the asset, the gain remains unrealized. In effect, the billionaire consumes wealth while postponing the tax bill indefinitely. This matters because time is not neutral in finance. A delayed tax is often much smaller in present value terms than an immediate one, especially when the underlying asset keeps compounding faster than the tax liability grows. If someone can hold an appreciating asset for decades, borrow against it, and eventually pass it on to heirs, the tax system can be sidestepped not by breaking rules, but by never activating the part of the rules that would create a bill. That brings us to one of the biggest hidden features of tax law, the step-up in basis. In many jurisdictions, when an asset is inherited, its tax basis resets to its market value at the time of death. That means the capital gains accumulated during the original owner's lifetime may never be taxed at all. The gains do not disappear economically. They simply vanish from the tax ledger. This is one reason wealth can become self-reinforcing across generations. A family can hold assets, borrow against them, and then transfer them with much of the lifetime appreciation effectively untaxed. This is the real reason the conversation about billionaire taxes is often emotionally charged. Most people compare billionaire wealth to ordinary income and assume the tax burden should scale in a similar way. But the system does not mainly ask, "How much are you worth?" It asks, "How much did you realize this year and through what legal category?" Once you see that, the pattern becomes much clearer. The wealthy are not necessarily escaping the system. They are living in the parts of the system that were built for ownership rather than labor. There is another layer here. The code does not just tax income differently. It actively creates incentives for certain kinds of wealth to accumulate faster than others. Long-term capital gains are often taxed at lower rates than wages. Interest can sometimes be deducted. Real estate can be depreciated on paper even while rising in actual value. Business structures can shift income, expenses, and timing in ways that reduce current tax liability. Each of these rules may make sense individually. Together, they create a landscape where asset ownership is structurally favored over salary income. That is why two people can earn the same amount of money in a year and end up in completely different tax worlds. One may earn it as wages and lose a large slice immediately. The other may earn it through stock growth, deferred compensation, or business equity, and pay little or nothing that year. The difference is not just wealth, it is the legal form of wealth. Some critics ask why billionaires do not simply sell assets and pay the tax. The answer is that selling is itself a cost, not just a tax event. Selling can trigger capital gains tax, reduce future upside, and sometimes signal weakness to the market. For founders, selling large blocks of stock can also mean losing control. So if the tax code rewards holding and the market rewards growth, the rational strategy is often to hold as long as possible. The result is a strange alignment. The most successful investors, founders, and owners are often the least likely to realize gains in a way that creates large annual tax bills. This also explains why many billionaires are asset-rich but cash-poor in the strict accounting sense. Their net worth may be enormous, but much of it is tied up in shares of a company or property holdings. That doesn't mean they are struggling. It means the tax code is built around liquidity and realization, not raw net worth. And because their wealth is often concentrated in assets that can appreciate for years without a sale, the tax burden can remain low relative to the size of the fortune. Now, to be clear, there are guardrails. Tax authorities know these strategies exist. There are rules on related party loans, wash sales, constructive dividends, and abusive deductions. Some wealthy individuals do get caught pushing too far. But the striking thing is not how often the law is broken. It is how much advantage is available without breaking it. The tax system is full of legal asymmetries that are perfectly rational at the individual level and deeply consequential at the aggregate level. That is why public debate often misses the real issue. The question is not whether billionaires can hire elite accountants to invent magic. The question is why the tax base is built around flows that are easy to measure, instead of the stock of wealth that is harder to tax, but more concentrated at the top. In a world where salaries are visible and assets can compound quietly, the burden shifts toward people who earn primarily through labor. That does not mean the system is a conspiracy. It means the system was designed for an economy where labor income was far more central than it is now. The result is a hidden trade-off. If you tax realized income heavily, you create incentives to defer realization. If you tax unrealized gains, you create valuation and liquidity problems. If you tax wealth directly, you face administrative complexity and political resistance. Every option has consequences. But pretending that the current system treats all forms of economic power equally is simply inaccurate. And this is the deeper point most people miss. Billionaires do not avoid taxes because they are uniquely clever in a vacuum. They avoid taxes because wealth itself is embedded in legal and financial structures that the tax code does not fully capture. Salaries are taxable because they are simple, immediate, and visible. Asset appreciation is harder to reach because it can remain unrealized for years, then move through loans, trusts, holding companies, and inheritance rules before a tax bill ever appears. The system is not failing at random. It is following its own logic. That logic has major consequences. It allows wealth to compound faster than wages. It makes ownership more powerful than work. It encourages political debate to focus on rates while ignoring timing, structure, and basis. and it helps explain why two people can contribute very differently to the economy, live very differently, and still end up with tax outcomes that seem almost upside down from a fairness perspective. So when people say billionaires don't pay taxes, the more precise version is this. Many billionaires pay tax on a much smaller slice of their economic gains than ordinary wage earners do on their income. They do it legally, using rules that were written into the system and reinforced over time. The real story is not a secret trick. It is a mismatch between how wealth is created and how tax law recognizes it. That is why this topic matters beyond finance. It is about what a society chooses to measure when it chooses to tax, and which forms of prosperity it ends up favoring. Once you understand that, the debate stops being about personalities and starts being about architecture, and that is a very different conversation.